Imagine your salary stays the same, but suddenly you're paying twice as much for your rent, food, and electricity. Or vice versa, everything gets cheaper, but you lose your job. Sounds like a nightmare? That's exactly what we're talking about today, inflation versus deflation. In this video, I'll show you what's behind these two terms, how they affect our economy and your daily life, and above all, which is more dangerous and why. And don't worry, even if you're not an economics expert, after watching this video you'll understand why these phenomena are anything but abstract. At the end, I'll also tell you how you can protect your money no matter what happens. Let's go. Inflation essentially means that prices rise and your money loses purchasing power. In other words, you get less for €1 today than you did a year ago. But why is this happening? Imagine there is a certain amount of goods in the supermarket, let's say bread, milk, and butter, but suddenly everyone has more money in their pockets. What happens? Demand increases, supply remains the same, and prices rise. It's the classic principle of supply and demand. A famous recent example, between 2020 and 2022, many central banks around the world pumped massive amounts of money into the market to cushion economic slumps caused by coronavirus. At the same time, lockdowns led to less production. The result? More money, fewer goods equals rising prices. And another point, inflation can also be homemade. When wages rise, the costs for companies often rise too. They pass on the costs, and products become more expensive. This is called a wage price spiral. What many people don't know, a certain amount of inflation is actually desirable. The European Central Bank is aiming for around 2% per year. Why? Because this encourages investment. If you know that your money will be worth less tomorrow, you are more likely to spend it or invest it today. Inflation becomes dangerous when it gets out of control. Then we talk about hyperinflation. Let's look back to 1923, the Weimar Republic. People paid with wheelbarrows full of cash because a loaf of bread suddenly cost billions of marks. The money was worth so little that it was used as wallpaper. Such extreme cases are often caused by excessive money printing, loss of confidence in the currency, and political instability. A more recent example is Venezuela. The inflation rate there was over 1,000,000% in 2018. People used dollars or even crypto because the bolivar was no longer worth anything. However, even moderate but persistently high inflation is extremely dangerous, and you notice it immediately. Food, energy, rents, everything becomes more expensive. Savings deposits lose value because you might get 0.5% interest on your account, but prices are rising by 6%. If you don't own any tangible assets, you lose money every year in net terms. People with a fixed income are hit the hardest: pensioners, employees, or pupils and students. For example, if you earn €2,000, but your expenses rise from €1,500 to €1,800, that's when things get tight. Deflation is the opposite. Prices fall over a longer period of time. Sounds great at first, doesn't it? Everything becomes cheaper. Why should that be bad? Because it makes people postpone their consumption. Why buy today if it's cheaper tomorrow? Imagine you want to buy a television. It costs €1,000 today, but you know that in 3 months it will only cost €900. Then you wait. If everyone does this, companies will sell less. Lower sales mean lower profits, lower wages, redundancies. And then people buy less again, a vicious circle. A real-life example, Japan. Since the 1990s, the country has been struggling with stagnating prices and low economic growth. Despite high-tech, efficient industry and innovation, there is no momentum because people save too much and consume too little. And for you as an individual, deflation means your job is less secure, companies pay less, investments are postponed. Debt is also particularly dangerous during deflation. Why? If your income falls but your debts remain the same, their burden increases in real terms. Many people think inflation equals central bank prints money. That's part of the truth, but it's more complex. Inflation is caused by increasing the money supply. If the ECB puts a lot of money into circulation, the value of each individual unit falls. Supply shortages, e.g. due to supply bottlenecks, energy crises, or wars. When products are in short supply, prices rise. Psychological effects. If people believe that prices will rise, they buy earlier and actually drive prices up. Politics. Tax measures, subsidies, or regulation influence supply and demand. Deflation is caused by decline in demand, such as recessions. When people are afraid, they lose the desire to consume. Technological progress. This makes many things cheaper, which is good, but also exerts pressure on prices. Demographics. In aging societies such as Japan, people save more, which reduces demand. Debt crises. When countries or companies reduce their debts, less money flows into the economy. The last few years have been extremely exciting or frightening. After the coronavirus crisis and the war in Ukraine, we experienced a historic wave of inflation. Energy prices have gone through the roof, supply chains were disrupted, central banks counteracted with cheap money. In 2022, inflation was almost 10%, a level that many have never experienced. But now, in 2025, some economists are saying that inflation is leveling off, and the risk of deflation, or at least economic stagnation, is growing. Why? Interest rates have been raised significantly, loans are more expensive, companies are investing less, consumption is collapsing in some cases. So we're at a turning point between two extremes. Here are 5 strategies you can use to protect yourself in both scenarios. 1. Bet on tangible assets. Shares, ETFs, real estate, commodities. These are things that exist in real terms. They retain their value even in the event of inflation. They often even increase in value. 2. Hold liquidity, but in moderation. A nest egg is important, but too much cash loses value with inflation. A good mix is crucial. 3. Manage debt. In times of inflation, old debts can become worth less in real terms, but be careful with new loans with variable interest rates. 4. Further education. Invest in your skills. People with know-how are in greater demand in any economic situation and are better negotiators. 5. Monitor the markets. Interest rate decisions, inflation data, economic growth. The earlier you recognize trends, the better you can react. So now you know, inflation slowly eats away at your purchasing power. Deflation freezes economies and deepens recessions. And the real danger? When governments and central banks lose control of either. What do you think is more dangerous? Fire inflation that spirals out of control? Snowflake or deflation that grinds the economy to a halt? Drop your thoughts in the comments. I'll be replying to as many as I can. If this video helped you understand money and economics a bit better, give it a like. Don't forget to subscribe for more deep dives into finance, business, and strategy every week. Thanks for watching, and remember, stay informed, stay sharp, and never stop learning.